So the goal of OpenStore is to allow you to serendipitously discover products that will inspire you and satisfy you and bypass the need to travel to an archaic version of retail. So the gross margins are higher than I expected. The goal was always from day one to have a destination app on every consumer's phone. Getting an app on 10, 20, 30 million Americans' home screen is a really difficult challenge. It's very rare, and you do not want to spend an infinite amount of money trying to do that. But the first step is understanding what your CAC payback is. So when you buy a business or drive a business, guess what? We have access to like a year or 2 years of operating history.
So then that's the advantage of buying some of these brands versus launching them.
So we understand that this product can be marketed at, call it a $30 CAC, and with a payback of, call it 8 months, instead of optimistically guess what our payback will be. If you launch it, you have no insight. Like it's certainly in the beginning, maybe at some level of massive scale, you can kind of do what Netflix sort of did with content.
It's almost like in a way you're taking this private equity type playbook where buy low, but then you never sell.
We never had the vision of like, we're going to, try to buy low and sell high kind of arbitrage. We were always building this to be a 10, 20 year journey to create a destination. This model will produce unprecedented contribution percentages that people in D2C have never seen before. So for example,
welcome to The Peel, where we explore the world's greatest startup stories. I'm your host, Turner Novak, founder of Banana Capital, the best venture capital firm that isn't based in San Francisco, New York City, or Miami. Today, I talked to Keith Rabois, the co-founder and CEO of OpenStore. I'm excited to share this conversation because what Keith and the team at OpenStore are actually doing is a lot different than the public perception. We'll dig into the problems that still exist in e-commerce 30 years into the internet, the 3-minute conversation that started the company, what exactly OpenStore is, and the reasons Keith thinks OpenStore will be 3 times more profitable than other consumer brands. Keith was an early executive at companies like PayPal, eBay, LinkedIn, and Square, a co-founder of Opendoor, and an early investor in companies like DoorDash, Faire, Affirm, Webflow, Ramp, and many others, and is also general partner at Founders Fund. He shares the single thing he looks for in founders he backs, a framework for founders and investors to consider when incubating companies, why he thinks great startups aren't being founded in San Francisco, why he's bearish on most AI startups, why he moved to Miami, and his 3 favorite interview questions when hiring. We really get into the weeds on OpenStore's business, and if you've been curious about what they've been up to, I think you'll really enjoy this episode. I also want to give a shout out to a bunch of people: Andrew Bracken, Parker Thompson, Malia Russell, Rohit Krishnan, Taro Fukuyama, and about 30 other people who submitted questions on Twitter and offline. Thank you, Keith, for coming on the show. Now, let's jump in after a quick word from friend of the show, Packsmith. Packsmith is one of our newest investments at Banana. It's an intelligent, distributed logistics platform that solves the last mile problem for growing brands. Instead of using 100-year-old warehouses like a legacy 3PL, Packsmith operates a network of hubs run by business owners out of their home, dedicated to your brand. They put your product right next to customers, which means cheaper and faster delivery. The team comes from companies like Uber, Cruise, and Amazon, and gives an insane level of transparency into your fulfillment, high-touch customer support, and unique packaging customization that you just don't get from a legacy provider. The visibility is key, and I don't know if I'm allowed to say this, but early customers are seeing fraudulent return rates cut to near zero after switching. They launched with the first cohort of brands this summer, and they're slowly onboarding new ones. If you're a growing Shopify brand, listeners of The Peel can head to packsmith.io/banana, packsmith.io/banana, or join over 50 other listeners and just tap the link in the show notes to jump to the top of the waitlist, and they'll see if your brand is a good fit to be an early customer. Thank you, Packsmith, for supporting the show. And now, let's talk to Keith about OpenStore. Keith, how's it going?
Great. How are you?
I'm good. I'm excited to talk about OpenStore.
So am I.
So can you tell us, why did you start it?
Yeah, so I started OpenStore because basically I was having brunch with Jack Abraham, who runs Atomic, which is a venture studio based in Miami. And he was explaining to me, this incredible rise of Shopify over the last 10 years that truthfully too few people paid attention to. But obviously I was familiar with the trajectory, the market cap. At the time we had this conversation, the market cap was 156 billion. And he said basically look, there's all these stores on Shopify that are kind of stuck. They're stuck because they don't have access to capital. They're stuck because they don't have expertise in scaling their business, and they need a solution. And then if you provided a solution, you could stitch that together into something more interesting. And as soon as he started explaining this at breakfast, less than a minute in, maybe 90 seconds in, all the dots snapped to me. And I said, yes, that's a great idea. Yeah, I can see what to build on top of that very easily. We should do this. So 3 minutes into the conversation, we agreed to start the company to solve the problems in e-commerce. So the fundamental problems in e-commerce, if you look, let's take a statistical view to start. Basically, we're about 30 years in since the internet kind of revolutionized how we shop in some ways. And e-commerce accounts for roughly, depending on how you want to, what methodology you prefer, 11 to 14% of transactions. It's kind of embarrassingly low if you think about that over 30 years. The fundamental reason, the fundamental blocker is that nobody in the West has created a platform where people discover things to buy that they don't know they already need, i.e. they have low purchase intent. So of course, if you have purchase intent, like I need diapers, or I want to find this book, plenty of ways to do that. E-commerce is incredibly efficient at that kind of exercise. Amazon itself is incredibly effective at that. And users and consumers know how to find those kind of products. But when you go in the real world, somewhere between 40 and 60% of purchases are things that people did not intend to buy when they walked into a store. So for example, let's try by metaphor first. When you go to a CVS, Walgreens, whichever you prefer, to pick up a prescription, there's a reason why the pharmacy is inevitably located in the back of the store. Because people went on their way and on the way to the pharmacy to pick up the prescription and on the way back from the pharmacy, wind up buying things. That is what e-commerce has not yet solved. So in fact, every horizontally interesting e-commerce platform in the United States was basically built 20 to 30 years ago. And so no one's been able to build an interesting horizontal platform in e-commerce that's transactional in the West in 20 or 30 years. And so we said, we think we have a formula that could work to solve those endemic principles. I mean, if you think about it from a consumer perspective, let's reverse engineer this now. When I go down shopping, there's a great shopping district, and it's called the Design District of Miami that I really love. I have to go there, I have to travel there, I have to Uber there or drive there, park. I have to go there between the hours of, depending on the day, 10 or 11 a.m. and 6 p.m. or 7 p.m. So when I'm supposed to be doing other things like working.
Recording podcasts.
It's incredibly inconvenient for a consumer, but consumers do this every day. We are expected to interrupt our lives to accommodate the convenience of the store owner. That makes no sense. So we should be able to replicate, let's say, half of the times and trips I take to a shopping mall or the equivalent in Miami, and make that happen 24/7 online whenever it's most convenient for me, which may be Sunday at 8 p.m. when every single one of these stores is closed, or maybe 7 a.m. in the morning when I wake up before I go to work. But that's impossible to do. So the goal of OpenStore is to allow you to serendipitously discover products that will inspire you and satisfy you and bypass the need to travel to an archaic version of retail.
And would the closest existing solution to this problem probably be Instagram or Facebook?
Well, so the way it works, insofar as it happens at all, is people are surfing their friends' stories on Instagram, and roughly 1.2% of those people get interrupted by an ad unit that resonates with them, and they click. And then roughly 3% of those people actually purchase something. It's literally 1.2% on average across Instagram, times about 3%. That is the most incredibly inefficient process of interrupting people to lead to serendipitous discovery. But yes, that is exactly how direct-to-consumer commerce works in the United States today.
TikTok is sort of like that.
Nobody buys anything off TikTok. Partially the audience demographics, partially there is a tension between a content consumption experience when you're enjoying the content and transacting. Those are very different mental models. And it's not surprising to me that when Facebook tried to launch Instagram shopping, it completely failed. There's a real endemic tension there, and TikTok has the same problem, so it's not going to work.
I think you'd have to be able to say it attaches to your advertising platform, and by making your advertising platform better, it increases the conversion rates in the ads based on how you design the whole experience. And then it probably comes down to, is it even worth Facebook's, I don't even know how big they are, $80 billion ad platform to try to launch and scale this minuscule e-commerce business?
I mean, obviously, Amazon's very scaled business would have a fair amount, to Facebook's market cap. And they kind of have to do it organically now, which makes it more challenging. It's not as if Facebook can acquire Shopify anymore.
So I was going to maybe get into this question a little bit later, but because you brought it up, what do you think about how the dynamics of Shopify and Amazon are kind of playing? It's kind of like two ends of the spectrum, because you're kind of we'll get into this, but you're kind of making a bet on Shopify in a sense.
Yeah, I mean, we believe that there's going to be independent brands that resonate with consumers, and that consumers are going to vote with their feet to purchase goods that are unique, differentiated, non-commoditized. Amazon is going to master the commoditization of products, and products that can be commoditized will be widely available, efficiently and reliably delivered through Amazon. And that's great. Consumption includes some very commoditized products. I have paper towels, like in my house. I need to restock paper towels. I need a source of that's reliable, and some versions of vitamins even. But fundamentally, there's a lot of products that are not commoditized. They're not replaceable. They're not scaled. They're intentionally not available at scale. And the brand owner doesn't want them to be available at scale. Think a luxury brand in the traditional world. Prada does not want to be sold on Amazon. It destroys the whole value of Prada to be available on Amazon.
So do you think then if OpenStore is really successful, Prada will be on OpenStore?
We have products that are even more compelling and unique. There are a lot of occasions when you want something that is different. For example, when you get a gift for somebody, the last thing you want to get for someone is a gift that you can find anywhere. Like, that's the whole point, is you want to put thought, and it wants to be unique. There's no way that an all-purpose marketplace does a great job of allowing you to get personalized gifts.
We should probably get into what OpenStore is today. What is it?
So when OpenStore started, we started with the value proposition that we would go to long tail of Shopify brands. Long tail defined as between $1 and $10 million of sales, annual sales. There's probably 30,000 of them that are in the US or focused on the US. So there's 2 million plus stores on Shopify. 86% of those stores sell less than $50,000 worth of stuff a year. So it's incredibly difficult to build. It's a heroic exercise to build a successful brand on Shopify. So what we do at OpenStore is we say to people who've succeeded and got to minimum 500K in sales, up to 10 million, and say, hey, if you don't want to do this the rest of your life, we will buy your business from you. We'll reward you for all the effort and the sweat equity and the stress that you put into building this business, and then we'll run the business in the future. And we have two different products. We have an acquisition, which is just like what it sounds. It's a standard acquisition. We give you money in exchange. You get 80% of the cash up front, and there's nothing you have to do after that. You get the other 20% like 30, 60 days later. And then we launched last year, February and March, a new product called Drive, which basically says, hey, if you built this brand and it's kind of your baby and you don't really want to sell it, but you want all the benefits, the cash flow benefits, the real economic benefits, we'll guarantee you the cash flow benefits for the next year in exchange for a small fee for running the business for you and allowing you to focus on other things in your life, whether that's your health, whether that's a vacation, whether that's your family, whether it's starting a new business. Any of those reasons are great reasons to allow OpenStore Drive to run your business with the guaranteed passive income that you expect. So there's really no trade-off.
Is it truly passive income? That's a pretty bold statement that I see that.
It's 100% passive income. There's literally nothing you have to do. We do everything and guarantee the cash flow that we showed you.
So maybe dialing back a little bit, you're also building a sort of discovery-based feed. It's maybe like the Facebook feed. It's maybe kind of like wish.com. Why are you acquiring brands? It maybe doesn't compute.
So there is a question of like, okay, so why are we acquiring these businesses? What are we going to do with them after we acquire them? Why are we driving them? What are we going to do with those products? We're going to stitch them all together into, you can think of it as a decentralized department store, just as a metaphor. So we need products. If you're opening a new department store, let's say you're starting a new Saks Fifth Avenue or Macy's, whatever it is, you need products and SKUs. Like you can't just open a department store with no products. So we take the products that we've acquired or that we're driving and we put them together into interesting ways. And so that allows us to have a value proposition to consumers that says, hey, come walk into our store and we're going to have cool, interesting products, just as if you went to Saks.
Why do you have to acquire the brands to do that? Couldn't you just say, hey, Turner, you have this really cool, I don't know, necklace jewelry brand. Do you want to come sell on OpenStore?
We could in theory, but I think there's a lot of benefits of acquiring them. One is you can mix and match products. For example, let's say a brand owner might not want, this water mixed with this other water. Once we acquire the brand, we can decide what's best for consumers. So maybe putting all the waters on the same shelf is better for consumers. Maybe it's not. But if you're not acquiring the brand, there's another third party that may have different interests. Like the consumer may love having this water next to this water and comparing this versus Propel. The brand owners of Propel and Perrier may not like that at all. So to deliver the best possible consumer experience, you need to have control. That's one. Secondly, because of the way Apple sort of regulates the entire industry, if you don't own the brand, it's really difficult to use data to target effectively. And so building a horizontally interesting marketplace, one of the fundamental reasons no one's done this is you have to be really efficient on your cost of customer acquisition and the time that it takes to pay that back. And over the last 30 years, every e-commerce horizontal vision has crashed and burned on bad CAC and payback times. So when you can use what's called first-party data, you can target the user a little bit more specifically, hopefully with better CAC and tighter payback periods.
And would that be because, maybe a tactical example, you have their email and their phone number, and you can just run a lookalike campaign or retarget?
That would be nice if that alone worked. In reality, the benefit is you can associate the purchases of a specific person back to one person if you actually are running the store. So if it's really yours, it's called first-party data. You can use that to target. So if you watch Keith buy a Perrier, you can infer and try to predict what other products might Keith be interested in that he doesn't even know he's interested in yet. If you don't own the store, you're not allowed to use the Keith purchased Perrier to run ad campaigns specifically on iOS.
So this would be like if I was using a third-party agency to run some of my ads to target you, and because they don't actually own everything, or can you explain that a little bit more?
Pure agency might be able to actually, because they are actually acting as if they're you, but you couldn't necessarily partner with another brand and share the data back and forth and use the targeting of the down to like the SKU or product level.
What sort of things do you do when you acquire a brand? Because I know I've heard you talk about, it's not just you buy it and then you let it go and you let it run. What happens post-acquisition?
Yeah, so we decompose running an e-commerce store into functional areas. So there's new customer acquisition, there's retention marketing. So for example, in retention marketing, we will create a native iOS app for each brand. And that allows us to send notifications. It allows us to engage with the consumer in a different way. There's customer support. There's fulfillment, which is shipping to the consumer efficiently. There's mixing and matching products, what we call cross-selling, which requires a logistical operation that can couple different products from different brands into one box. And then there's sourcing, getting the underlying goods efficiently, predictably, in a relatively attractive, margin. So we do all of that. We break it down functionally. So there's different teams that specialize in each of those areas that have functional expertise.
So to what extent are most of these brands doing this already?
None of the brands would have functional expertise divided this way. None of the brands we've ever worked with had a native iOS app, for example, just that one dimension.
Why is the native iOS app important?
Consumers like to purchase things on iOS. Your conversion rate will go up and you forge a direct relationship. Like being on the home screen of a consumer's phone means they're going to engage with you much more frequently.
So let's say you acquire Turner's water brand or Perrier, whatever. There's a Perrier or a Turner's water brand app, or is it an OpenStore app?
Currently, there's a specific app per brand. We will have an app or two that unifies a bunch of our product catalog.
So if I was just the independent $1 million in revenue, makes no sense to probably build my own app. How many brands are you at today?
Plus or minus 50, let's say.
So you probably have a team that there's people that are just cranking out these apps. I'm assuming you have a pretty good process.
We have a wonderful iOS team.
Does that lead then into, you can almost circumvent, don't even need to run ads because you've got the customer relationship.
One of the magic vision behind the company was, I don't know whether it's at 10 million consumers or 20 million, somewhere in that zone, maybe worst case 30 million. You don't need to pay the Instagram tax anymore. You can recirculate buyers and send new buyers to different brands consistently and constantly. And then the economics, the P&L of the business looks fantastic.
There are some companies that acquire brands specifically on Shopify, or maybe they run on Amazon, but they don't necessarily go to the same extent that you guys do. What do you think that some of those brands that may be done wrong, or some of those aggregator models?
Well, it's a dumb model. An aggregator model makes no sense. It was a complete arbitrage model, and arbitrage has eventually collapsed, and you can't build a technology company for 20 years on an arbitrage model. It was literally a dumb idea. It was a zero interest rate phenomenon on steroids, actually. It was like, we're gonna buy things at 5 or 6 EBITDA, and because the market is trading at 10x EBITDA for now, there's a spread there. The problem with that is that arbitrage will inevitably collapse. All arbitrages do. So the only thing you can do is time. And that's not a real business building. Timing is not business building. So secondly, the other problem is all these aggregators literally were focused on Amazon. The good news piece of that is it's easy. Like you buy an Amazon store and Amazon does all the hard work. They fulfill things, they ship things, blah, blah, blah. Everything's great. I could do that in my sleep. The problem is that after that, you realize, oh, shoot, we bought at 4 or 5x EBITDA. How are we going to make this a better business? The truth is there's no way to make it a better business. Amazon runs fulfillment very, very efficiently. Amazon does all the customer acquisition for you. What the hell are you going to do to improve the business? There's nothing to do. So you're kind of stuck. It's just not a good idea. There's a reason why, basically nobody serious invested in these companies.
And then rates were you could borrow money at a couple percent.
There's a time, and arbitrages usually exist because there's a weird confluence of events in the world that create a dislocation that you can take advantage of. If your goal is solely to make money in life, arbitrages can be great ways to make money as long as you know how to get out of the trade.
So is that sort of what you did then? You did it. You were sort of entering, but you had a way to get out.
We never had the vision of we're going to try to buy low and sell high kind of arbitrage. We were always building this to be a 10, 20 year journey to create a destination. The goal was always from day one, breakfast one, to have a destination app on every consumer's phone. And then the art is how do you get there in a cost-effective economically efficient way. Getting an app on 10, 20, 30 million Americans' home screen is a really difficult challenge. It's very rare, and you do not want to spend an infinite amount of money trying to do that.
So in a way, you maybe took advantage of the arbitrage that existed, but you had this end destination, getting on all these phones and building like a true technology business.
Well, we thought about it from an investor standpoint, which is like Jack's a VC in some ways. It's a venture studio, close cousin to a VC. I've been a VC for 10 years now. We basically said, like, what are all the reasons why we would never invest in a new e-commerce startup that was trying to have a horizontal startup to create a destination app on a consumer's phone for transactions? And we said, we're not going to have any of those flaws. It doesn't mean we can do it, but we're going to get rid of all the theoretical reasons why we would never invest in something.
So do you remember what those reasons were?
Incredibly bad payback, period. Like the CAC payback time is not sub 12 months in any of these companies. B, they're not even known. C, like you have diseconomies of scale in some ways. Even critical mass on that is also challenging. I think there's many ways. And then B, you have to have a vision of what do consumers want? Like, what is that value proposition on the phone? It can't be about shopping directly. By definition, if you have no purchase intent, you don't open a shopping app.
Bad CAC payback, you get around that by just kind of structurally lowering the CAC by doing some of this cross promotion and borrowing.
That is definitely critical. But the first step is understanding what your CAC payback is. So when you buy a business or drive a business, guess what? We have access to like a year or 2 years of operating history. So we understand that this product can be marketed at, call it a $30 CAC, and with a payback of, call it 8 months. Instead of theoretically, we're going to launch a whole new company to ship these things, and we're going to optimistically guess what our payback will be.
So then that's the advantage of buying some of these brands versus launching them.
If you launch it, you have no insight. Like it's certainly in the beginning, maybe at some level of massive scale, you can kind of do what Netflix sort of did with content, which is you understand consumer behavior based upon data that you have unique access to and kind of predict. But that requires like massive data, massive scale.
And that's sort of what they did. They sort of did what you did, where they acquired content that already existed.
We are following the Netflix strategy for products, actually. That is intentional.
So what is the Netflix strategy for products? Can you explain that?
Yeah, we are acquiring content with an audience. We're going to cross-populate the content consumption to increase the value prop. We're not going to charge a subscription like directly, so the metaphor breaks a little bit, but we are going to cross-pollinate content or cross-pollinate products, which makes better economics. And then we're absolutely eventually going to use the data based upon consumption to predict what we should be doing differently, like what products and SKUs should we be either building or buying, and why is it economically more efficient for us to buy than somebody else.
So have you had the data influence any decisions that you've made yet? Any big realizations or strategy changes you've gotten because of what you've seen?
I wouldn't say we've had any strategy changes. Obviously, you get better at modeling things like the more times you do X, also the more times you try to do Y in operation, like post-acquisition. You have to learn muscles. Like there's a lot of muscle building that goes into this. But then there's also economies of scale. Like the reality is our shipping costs are significantly lower. Our fulfillment costs are significantly lower. It's a function of having more transactions and more products, more consumers. So that's just a question of you just have to get to these kind of new tiers of volume to get the benefits.
And is that probably because a lot of these brands most likely use a 3PL, outsourced all their shipping? Are you bringing it all in-house?
We bring it all in-house, or we work with a 3PL, but it's kind of a custom relationship. So 90% of our products are basically one 3PL. And we send a decent amount of packages compared to the $1 to $10 million, brand that we inherited.
So you essentially like slowly, I know in shipping, like a big thing, the more size you do, more volume, bigger discounts.
And so the cost of shipping goes down, which either means you can offer better shipping terms to the consumer, offer free shipping to the consumer, or you can just expand your margin, which allows you to pay more in CAC, but still have the same payback period.
What does the general sort of, financial profile look like of one of these D2C brands? I hear all these horror stories or see horror stories like they're bad businesses, they shouldn't have raised venture. What's going on under the hood?
Well, none of the companies we worked with have ever raised venture capital. Virtually none have raised external capital, period. There may be slight loans here and there, but like very small, but never venture capital. Venture capital into D2C is a pretty precarious exercise. There's probably a few that kind of made it, but like fundamentally, most brands, most ideas are not suited for venture capital in direct to consumer world, but there are some outliers. But fundamentally, the ones in the $1 to $10 million sales bracket typically have not raised venture capital. So I don't think we've ever even priced a business, made an offer to a business that raised venture.
There's probably a lot of complexities just sorting out the cap table.
The cap tables we look at are very straightforward. There may be liens like debt, various things like that, or et cetera, or tax payments that need to be made, et cetera, to be compliant. But there's never like true cap table complexity compared to like what we use VCs.
So what are typically, I guess, the margin profile, like gross margin? I'm assuming you probably got to be at least 60% in order to be a good D2C brand. Is that fair to say?
It varies widely, both by the operational expertise of the brand owner, be by vertical, like category. I'd say on average, if you guesstimate it, you're around the 50% mark. That's pretty good. And there's categories where like 10 to 20% is pretty good. And there's categories where you want to be 60% plus. So you have to kind of benchmark by category. Like apparel may be different than consumer electronics, which might be different than, let's say, health and beauty or supplements.
When you're looking at, assuming CAC marketing is a pretty big expense, are there any safe zones or danger zones? Like you're like, wow, they're only spending 20%. That's good. Or maybe we can increase. Or you're like, wow, these guys are spending 80% of revenue on marketing.
Yeah. So I don't look at it from that metric. Some people do. I've never used that metric. I tend to like to look at just pure payback. So it's like you spend X in CAC and based upon your margin, how fast what the consumer pays you in the margin, how fast do you pay that back?
What do you typically see then on the average repurchase rate for some of the brands that you have on the platform? Are people once a year, quarter, month?
This varies a lot based upon, think about the products we sell. So for example, one product we sell, one of our popular brands is called Exo Drones. So it's the best US manufactured drone. So you don't have Chinese spyware in your drone. And so you're not going to buy drones like every week. Like that'd be like insane. So the retention in theory, now you do buy batteries. So if you include battery refresh, obviously the retention's high, but actual drone purchases, there's a certain tempo to a drone purchase, which is going to be closer to annual than weekly. On the other hand, another great brand of ours is Jack Archer, which is like athletic leisure wear, where we sell like shirts, we sell pants that you would wear to work, we sell boxers, which where it started, boxer briefs. So obviously the retention on that, you'd expect a much higher retention rate. Like it's very reasonable to expect people to buy something every month. So you have to know the product category. We sell like these kind of cute sofas for the young kids to sit on. You're not going to buy that like 5 times a year. So you definitely want to have like a unique T-stop sort of per product.
I think the unique thing with kids, I have 2 kids, they're 3 and 7. You buy more, if you don't have kids, you buy more things than you think for kids.
Oh my God, yeah. Like, I'm going bankrupt with our 2 kids. 3 or 4 months, they need everything new.
Yeah. Well, the thing I say to people always is like, if you've never had kids, the way to think about your new life is whatever extra discretionary income you had pre-kids, it just all gets spent.
Yeah, we better have good returns in Founders Fund because like we have 2 kids and they're incredibly expensive.
So you said something really interesting that I thought was, I don't know, in the context of what you're trying to build, I thought was maybe not that intuitive. You've said it's good to have a long tail of not that great brands versus like really focusing on hero brands. Can you kind of explain that?
Yeah, I mean, if you think about like, how can we add value? Let's assume we offer you the fair market value for your business. And you're like, yes, we want to create value on top of that. The larger that brand is, the more efficient it probably is. Like the more the cost structure probably already benefits from economies of scale. By Darwinistic behavior, you probably crack the code on some things. Longer tail, there's more room to improve the business by definition. And so to some extent, there's a better opportunity for increasing the value of a business the smaller it is. Like let's say we don't buy businesses that are $100 million in sales, but let's just walk through the experiment. At $100 million in sales, the business is probably pretty well run actually. They probably do have, maybe they're all the way up, stepped up all the way down the cost curve and fulfillment and shipping and stuff, but it's probably pretty good. Their payment terms are probably pretty good too, et cetera, et cetera. And so I think as you go down the long tail, they're just not qualifying for the lowest possible rates. And so there's room there. And then there's some benefits of investment where the fixed cost of investing in, let's say, an iOS app just doesn't make any sense below a certain threshold of sales or customer base size.
And basically what you've done is you've set up a portfolio. I'm sure you've done this a bunch of times with all the brands. So you acquire someone, $1 million in sales, you're probably getting better and faster at scaling them. And you know exactly what to do. You know exactly where the margins can be had. It's almost like in a way you're taking sort of this private equity type playbook where it's like we talked about the buy low, but then you never sell.
We're not trying to sell, but if we can expand margins, great, or lower prices to consumers to get more sales, that's even better.
I'm curious in your take on why you think Wish didn't work, because Founders Fund was an investor. I'm assuming you were somewhat close. Anything you think that they kind of tripped up on?
Well, so I was the first investor in Wish personally, like as an angel. So I know the company's history and the people pretty well, but I wasn't involved in Founders Fund. I hadn't joined Founders Fund when we invested. And so kind of removed from the later days. But my general sense triangulating is they were very successful. I mean, the company is a $30 billion market cap company for a while. So they did crack a lot of codes very, very successfully. But the price, the AOV band, the average order value band, price band, that they were successful in stayed pretty tight, and might have been a mistake to try to keep it that tight, but they were efficient. They're so efficient and so successful at it that there probably was a lot of antibodies in trying to expand up the AOV chain. So for example, at OpenStore, our AOVs range borderline 2 orders of magnitude. So we do sell products that are like roughly $50, and we definitely sell products in the thousands of dollars. We've sort of intentionally tried to be both horizontal across the Shopify platform by vertical and across AOV bands. But I think they basically got stuck in a very tight band and either ran out of consumers, that really want to constantly buy in that band, or ran into some other challenges. That's kind of my spidey sense from afar at this point.
I've definitely heard similar stories. I think the other thing was they changed shipping prices from China to the US, which I think impacted things a little bit.
Yeah, I don't know that, but if you looked at our seed deck, so this is the seed deck before we even launched anything, we said we want to be Wish, but for every price point. Or we want to be like Wayfair, but across all verticals. So those are the two kind of metaphors we use with investors.
And then when you talk about AOV being, $50 to $1,000, is that multiple products in one order?
We do sometimes, but like I was using the AOV range from like the first product. It ranges from like $50-ish to like several $1,000s. So that is like roughly 2 orders of magnitude. I don't know if we go all the way up to 5,000, but pretty close.
So then when you acquire some of these brands, are they doing any of their own production, or are they kind of just drop shipping from an overseas manufacturer to someone? How does that typically work? And then how do you change it?
Rarely are they doing fully their own production, not never. And we have inherited some, we've had to exclude some that are doing so custom production that it felt like really difficult to recreate, but we do some. They're not that often drop shipping. I'd say something like 20 to maybe 30% at max have been drop shipping. We're interested in drop shipping brands and products if they resonate, and we like acquiring them. Frequently, we will convert a drop shipping brand into a fully stocked brand, meaning we bought you, you're running a drop ship brand. We're like, hey, this is great, but consumers have to wait 17 days to get their product. That it doesn't make sense. So why don't we stock the inventory, because we can predict the orders, and so that consumers can get delighted and get their brands and get their products in 2-3 days. So we've done that regularly now. It's like a program where we take a drop shipper and convert it into a fully stocked brand so consumers can be delighted. And then there is some margin there too.
What have you noticed is the main reason that a brand sells to OpenStore? Like, is there a certain thing that comes up? Is it price, convenience, ease of mind?
There's several, and there's kind of almost different personas in quotes. So there's definitely some who, want to do something else with their life. Like, I want to start a different business. I want to be in a different business. There's some that want the economic benefits. We give people a lot. When we buy their brand, they're getting a fair amount of money.
That's an awesome outcome.
Especially if you're living in the Midwest or somewhere normal that doesn't have inflated cost of living.
Yeah, buy a nice house and
$1 million in the middle of the Midwest without like high income taxes, state income taxes is a lot of money. We write big checks, and then some actually do have reasons why they can't sweat 24/7 anymore. Some may be tired, like emotionally. Some may have family issues, health issues, other unfortunate reasons, but they just can't put the pedal down for another 10 years. If you think about it this way, if you said to someone, you can start a Shopify brand, but your only 2 outcomes are to run it for 40 years or hope you hit the lottery, and there's some like venture capital or something out there. A lot of people would hesitate and not start a Shopify brand. So by giving people a light at the end of the tunnel that they can choose, after 1 year, after 2 years, after 3 years, after 4 years, I can cash this in. It makes it more likely that people will become entrepreneurs and start Shopify brands, which is really exciting.
That's fair. You want to give them a real tangible outcome.
Also, you don't want to have to run something for 10, 20, 30, 40 years. I mean, in the real world, people might start like a local business and, force their family to inherit the business and run the business. That's actually what used to happen. I mean, that is like sort of what happens when you start a pizzeria or something. You might run it for 10, 20 years, but what do you do afterwards? You could try to sell it maybe, but like often you're handing it off to your family members. So in the Shopify ecosystem, you need kind of an off-ramp that makes sense on your own, where you control your own timing and your own destiny but it's not requiring you to run this brand for the rest of your life because it's hard. It's really emotionally draining. It's psychologically draining, and it's just metaphysically draining, meaning like there's so many things to do constantly. It's like being a hamster on a treadmill.
That's fair. I don't think I've ever really talked about this publicly or on the podcast, but my partner and her parents they sort of run, it's not a full-time thing, but they 3D print nail polish holding cases. So we have about 30 3D printers in our basement and they sell them on Shopify. They probably do about $100,000 a year in sales. People go crazy for these things. Like these older women that spend $1,000 a year on their nails.
You should apply for our new Boost program, which is designed for people between $100,000 and $500,000 in sales.
Oh, interesting. Okay. We'll dig into it. But anyways, it's so fucking hard. Like they spend so much time on it and there's 3 of them and they probably make net a couple dollars an hour each.
Yeah, no, exactly. It's really, really difficult. And so what we're trying to do is de-stress and make it easier by like giving you the economic benefits without all the suffering.
And then I think this really interesting program that you did, I think you mentioned Drive. Can you maybe explain that a little bit more? It's kind of like an outsourced management team.
Better than that because we guarantee you. So the problem with outsourcing management or agencies is you have no idea about the quality. People market it, but like you may not make the money you're expecting. So at least when you're running your own business, you control your destiny and you see the manifestation of that in terms of dollars you keep every week, every month. So what we do is we project your current data. We show it to you. We say, here's our extrapolation of how you're doing and what we think you're going to do next year. And if you think this is accurate, click here and we'll guarantee it for you. So there's no risk to the owner because we're guaranteeing you the cash that you would have made. So we basically allow you to that's why it is passive income it's like a cash flow stream. You're getting this, kind of hell or high water, period. So the only thing you have to do is let us drive it and, we'll take care of the business and give you the money. I kind of wish I could do this as a VC. Like if I could get all my carry and not have to do any of the work, it'd be great.
Yeah. That's always the best
Maybe
job
we
in the
should
world.
start this, drive for VCs.
Yeah. We'll make all the investment decisions. We'll raise all the money from LPs.
He's going to guarantee me to carry though. That's the key.
I don't know. Something tells me that there's maybe some people who sort of have that set up or think that they do and act.
Yeah. But anyway, anybody who wants to guarantee my carry for the next 10 years and I don't have to do any work, please call.
We'll put your phone number in the show notes and people can
tell me it's posting my email address so you can just use that one.
So with Drive, you guarantee a percentage of profits. It's not even revenue. I think normally I'd see someone say, oh, we'll take 20% of revenue, X amount of revenue. And you take, I think the last public number was 10% of profits. That's a bold thing to do.
It's a great deal. We've thought about whether we should do it off sales or profits. There's benefits of both. The benefit of off sales is kind of the world of Shopify ecosystem kind of works that way. And the pricing sort of compared to other people makes a lot of sense versus like a profits. There's pros and cons to each. We might switch back and forth or try different things there, but we will guarantee you what you expect. We're going to show you literally a cash flow forecast. And you're accepting that, like it's not like hypothetical. It's like, yeah, I agree. That looks like a reasonable projection of what I think I can do myself. So that's fair.
And then do you capture a little bit of the upside? Like if you surprise, like if it's double the profits that you projected, you get a little bit more than 10%?
We don't get a little bit more than 10% currently. Well, in theory, it depends on the there's a bunch of permutations of why and how it would. So, for example, if we took that product and married it to Jack Archer and that succeeded, we might capture more. But like basically, we're guaranteeing your income that you're expecting with like no risk, and hopefully, we'll figure out ways to be even more successful than that. And then you get, it's basically like a year contract and you have the choice to whether you renew or not 9 months in.
So if I want to do this, if I want to have you take control, I'm not going to sell, but I'm giving you access on Drive, what happens?
It's the same process as if you sold in some ways, like we have an onboarding flow, et cetera. It's very, very similar. It's one of the reasons why we could launch this really quickly is it's really running on the same train, whatever tracks. It goes into the same process. It's treated the same way. So there's no real delta in what you would do.
But you don't necessarily have to put up the financing either. It's probably a little bit more capital light for you also.
Paying out monthly versus paying up front, it's not that big a delta, honestly. Over time, I could see there's some advantages there where you could have a product that allows people to choose how much they want up front and how much they want later. And there's kind of an embedded interest rate and time value money discount in there, but it's way too early and premature to like be that clever.
How big is the business today? Are you revenue, employees, customers, GMV? I don't know what you're comfortable sharing, but what's kind of the state of OpenStore?
Well, let's work backwards. We have about 130 employees based mostly in Miami with a reasonable sized engineering office in San Jose. We are looking for very specific roles. So if people have great talent, please also email me, Keith at Founders Fund. The most important metric for us is our contribution dollars and margin. One of the things we want to prove is that this model will produce unprecedented contribution percentages that people in D2C have never seen before. So for example, I mentioned in our seed deck, we talked about Wayfair and Wish. Wayfair for every vertical. Wayfair has like 700 brands stitched together pretty elegantly, actually.
Do they also acquire or launch their own, or is it third party?
I think they aggregated a bunch. I don't, for the last X years, they may have done different things than they did the first 5 or 10 years. I looked recently at the data when they went public on their IPO. Their margin percentage was 7%. We're already well north of that. I want to put up numbers, like I want to be 20 plus. And the reason why is if you have this model that works, you should have one of the reasons why like investor types, whether they're private investors like VCs or public investors like public market investors, don't love direct to consumers is they're looking at the margin profile and they're saying like that's not that exciting a business. So I want to fix that, and I want to fix it immediately by showing that we have durable margins that are much more interesting and hence should earn a significantly higher multiple than a traditional D2C business. So that's the most important metric this year for us. There's ingredients and inputs that go into that. For example, how often can we cross-sell one product to a different brand that drives an increasing contribution margin? So there's like levers that drive the output, but the output needs to be very impressive on a contribution margin percentage. I think like almost every other company I work with, the growth rate isn't that critical right now as opposed to the margin increase, like showing our fundamental unit economics work and are attractive and are compelling compared to public companies. Having done a rough survey of like all D2C brands, I think in the public markets, anything like that even approaches 20% for a D2C brand is pretty damn good. It's like A level performance. 10 to 20% is kind of A minus to B plus. We want to be well north of the A.
Can we really quick explain contribution margin for someone who doesn't know?
So let's start at a conceptual level first. It's easy. Most people understand sort of what gross margin is. And what gross margin is really like, here's what the consumer pays you minus the cost of providing that product to the consumer. That's your gross margin. And especially any cost that's variable to that consumer definitely needs to be baked into your gross margin. The biggest difference, in 99% of the time, the only difference between gross margin and contribution margin is you take the cost of acquiring that consumer and you subtract it out too. So that yields about a money. And the reason why it's so magical, it's the money you actually keep. If you calculate your contribution margin correctly, it should actually tie to your bank account. In other words, for every contribution dollar that you show, that should map back to what happened to your cash flows in your bank account. And there may be time lags about when you get paid and stuff, so it's not like super simple, but fundamentally, every contribution dollar should be real. So that's why it's so important, is it maps to like real cash flows in real bank accounts. Everything else is kind of an accounting sort of fake statistic.
And so a way to think about it would be if you sell an item for $100 and your contribution margin is 20%, you will earn about $20 in just pure cash.
You should literally keep as a company $20 after all the costs of getting that consumer, making them convert, providing the good, paying out the suppliers, paying the shipper or whatever that marginal cost, all those marginal costs, the $20 you should keep. A simple metaphor is, let's start with gross margin. A simple metaphor that I like is you go to a restaurant and you order a dish. What's the cost of that dish? Let's say, okay, then subtract out now the cost of the ingredients and this is where it gets a little more complicated, the labor to create the dish. That is a little bit trickier calculation. So this is what happens in the real world, why accounting is more difficult in practice than it might seem in a textbook. But fundamentally, it's the cost of the ingredients and the preparation subtracted from the price the consumer pays. And the more people value your restaurant, there's usually a premium there. And the same thing's true. Now, where contribution margin would count is what was the cost of getting you to show up at that restaurant? Did you spend money advertising, on Yelp? And what was that cost? And then you subtract that out too.
And then do you usually incorporate something like a fixed cost, like rent, salaries of employees, or is that usually what the difference is?
Typically not. Like the fixed costs are basically should not be included in contribution margin. It gets a little complicated in enterprise software companies, particularly that use sales like as the primary engine, because you're usually paying a base salary to a salesperson regardless of what he or she sells. And then you're usually paying some variable compensation, which absolutely should be incorporated in the subtraction for contribution margin.
So then a way to think about it would be, I'm assuming because OpenStore is a startup, you're probably technically unprofitable.
Oh, we're definitely unprofitable.
And that's what it was with most tech companies. It's like they're growing really fast. They're set up to scale. Their contribution margin is positive. It's whatever percent, but they technically lose money. But the reason the contribution margin is important because you're saying each new dollar that gets added, our margins go up.
Right. The most important thing is that your contribution margin moves to positive as fast as possible as a startup, because it means for each incremental unit, each incremental consumer, each incremental purchase, you're getting some money back. If your contribution margin is negative, every time you grow, it's getting worse. Your bank account gets depleted. So it's extremely dangerous to scale a business that has a negative contribution margin.
So then would you recommend founders really understand their contribution margin? Do you hire a CFO, a finance person?
Yeah, this is pretty critical and pretty substantive. This is what I do most of my other time is like give founders advice. Be very specific here. First thing is it's absolutely indispensable to understand your contribution margin as early as humanly possible. Because again, it's like flying a plane. If you're aimed above the horizon, you're not going to crash. If your contribution margin is negative, the faster you grow, you're going to run out of cash really, really quickly. So you need to know that and need to know that definitively ASAP. Then secondarily, I believe specifically it's the founder's responsibility to really master this. Typically in an early stage startup, you're not going to hire a CFO. You're not going to hire a finance person, even in the first 5 to 10 hires, typically, maybe not even 20. And so the CEO needs to master this personally. Then when you get to a certain amount of scale, typically you'd get like a head of finance, probably not a CFO, but a head of finance kind of person who can help polish, track, derive insights that are not intuitive. But really the best founders kind of learn this stuff. I've watched founders literally read S1s. I think that's a little overkill typically for an early stage startup, but I say they want to master it, they really mean I want to master it. They read a bunch of S1s and they have footnotes and questions and it's great. But that level of mastery is pretty valuable actually.
And so an S1 is when a company goes public, they file like a 400 page document with the SEC. And the S1s are interesting because when a company puts out their earnings, it might be 100 pages with the SEC. But the S1, when they go public, it's very detailed and they spill everything typically, or they're a little bit more open. So you can learn a ton.
The P&L level precision is usually pretty solid. Some kinds of contribution margin calculations are very easy to do and some are a lot more complicated. So like, for example, as I said, it's theoretically quite easy to figure this out. In practice, low-level details matter. So for example, let's take a hard one, accounting-wise, is like, think of a company like DoorDash, dual-sided marketplace. And typically in a dual-sided marketplace, you may spend money getting drivers, acquisition for the drivers, and acquisition for the consumer.
What about the restaurants too?
In theory, you might too. Very messy. Now, the reason why it gets really complicated is the consumer stuff's usually pretty easy. It clearly requires to be offset against margin to derive your contribution margin subtracted. Now, imagine though the acquisition of a driver who does four deliveries, let's call it an hour, works, maybe they do 2, maybe they do 5, somewhere in that zone. And they work, X hours a week times Z weeks before they quit. Where do you bake that expense of acquiring that new driver into your contribution margin? It gets pretty non-trivial actually at that point.
So what do you recommend in a situation like that?
Most businesses are not that complicated, so don't obsess on mastering DoorDash's S1 unless you are in a dual or triple-sided marketplace, as you point out. Then you may need to think about like what precedent is out there and map to that precedent of how does DoorDash report its earnings. And at least for an investor conversation, it's good enough to say, this is how we're calculating it. And we're predicating the way we're calculating it on the methodology DoorDash used. That is perfectly acceptable for Series A.
Yeah, I also want to say, like when you're raising a seed Series A round, you don't have to be specifically precise or an expert on all this stuff.
A seed round, you definitely don't, because you may not even have actual data. You want to be able to understand the concepts at a seed round, though, of like, why do you think you can deliver a positive contribution margin? Isn't your cost here going to be this, this, and this? And isn't your pricing going to be here? You want to walk through the theory of how it could work out at a minimum. Series A and B, you will have actual data, and you're going to want to talk about like, well, it's X, and the way it gets to Y is these levers.
And then you got to get the investors to buy into the levers.
The levers make sense, probabilistically that you can achieve those. You've seen other people do it. You have an insight of how to do it, et cetera.
One interesting question, maybe sort of related. It's from Haro Fukuyama on Twitter. When you meet a founder for the first time, pre-product, what do you look for in that meeting?
So at a conceptual level, a non-zero probability that this person can change the world or an industry, reinvent an industry. That's the only thing that's going through my brain. Almost everybody in the world's probability of changing the world rounds to zero, like period. Yeah, or any industry. Like you could apply this to non-sharp say, you walk into a bar and there's a DJ playing. What's the chance that that person's the next Martin Garrix? It rounds to zero. You meet a high school athlete. What's the chance that that baseball player is the next Derek Jeter? It rounds to zero. You meet, some politician who's running for local office. What's the chance that it's the next Obama? It rounds to zero. So what I'm looking for is some spike in some dimension that this specific person actually can change the world and reinvent an industry, and that the probabilities are not zero.
So what would that look like? Is it intensity, knowledge, charisma?
Any of the above, actually. So what actually happens is the spike per great founder, extraordinary founder, is different, but it's top 1 or top 10 basis points in any one of those dimensions you just named. Any of those would be great. If someone walked in my office today and was top 10 basis points in any one of those dimensions, I'd be really excited to invest.
Even if you don't like the market, or do you also play that?
I could care less.
Well, and we're talking about like pre-product also. I mean, they could pivot.
If they're really extraordinary, they're going to filter things probably even better than I do.
This is from Andrew Bracken on Twitter. He asked, how's the vision for OpenStore changed from when you started it?
Hasn't changed at all. You definitely learn things, and some things are easier than you expect, and some things are more difficult. Typically, more things are more difficult than easier. But so you're always trying to get from point A to point B. But I'm not a big fan of changing the vision at all. As I've explained other places at length, is I think producing a startup is like producing a movie, and you don't change the vision of your movie because someone doesn't like it.
What's been the biggest surprise? Anything that you didn't quite see come in, or?
A few things, actually. So the gross margins are higher than I expected. In a market like this, you'd expect lower gross margins, actually. In theory, like in a hyper-competitive market with a lot of fragmented players, you'd expect the margins to be lower, at least in standard economics. But they're pretty persistent, durable, and close to that 50% zone. That was a definite epiphany that this is the real margin on Shopify.
Apple made a bunch of big changes to their ad network. I think it was probably right before you started the company.
Right. Well, they had foreshadowed most of it and then implemented it after, but it was pretty obviously forthcoming. Let's put it that way. But how impact on us has been pretty negligible because most of the brands at the size we're talking about weren't doing super clever hyper targeting. And so I think you did see a major shift in D2C for the larger brands over $100 billion that had very clever, efficient targeting, and they were directly impacted. I think at the longer tail version of Shopify, the level of precision of targeting wasn't that incredibly sophisticated comparatively. So when Apple dumbed down what you could do, it didn't have as much of an impact on the long tail. There's fears that it would, but in practice, it didn't.
You probably see it show up in the bigger companies.
The bigger companies were radically affected. That's partially because they'd invested in this amazing engine that was, super efficient at targeting. And I don't think longer tail businesses had the luxury of doing that, so they weren't quite as impacted. It sort of leveled the playing field between longer tail brands and larger brands in some ways. Not obvious, not well understood the topic, but it may have actually.
The brands you're acquiring, are they usually 100% Shopify, or are they selling a little bit maybe on Amazon or Walmart Marketplace?
By definition, they're more than a majority on Shopify, probably well north of 70%. Occasionally they have some other channels, but it's actually pretty rare.
Have you explored, when you talk about improving margins and improving the business, throw it on Amazon, do an extra $1 million in revenue, or is that not a good idea?
It's not strategic, but we do it for two reasons. We will do it in two cases. One is like any other retailer, we occasionally have excess inventory. So you need a way and outlet for excess inventory. So clearly that can be successful. Secondarily, there are a few brands, one specifically I'm thinking of, where they had some success already. I think they had 30% of their sales through something like, other channels or retail, Amazon, whatever. And so to give the business owner a fair price, we needed to continue operating the business that way. Otherwise, we couldn't round 30% down to zero. It wouldn't have been fair to the owner. So we preserved that in that particular case.
If the business is already operating, everything's set up, the inventory is there to be sold.
It's not super strategic, but the reality is we make fair market value offers, to our brands. And if they're profiting from some channel, it's really hard to match our offer without giving them some credit for that.
So this is an interesting question that I got from someone on Twitter, Malia Russell. She asked, how do you think about incubating companies?
We like it at Founders Fund. As you know, my colleague and partner, Delian, incubated Varda. Trey Stevens, general partner here at Founders Fund, co-started Andorel. So yeah, Peter back in the day, Palantir. So we're big fans of the model. I think it's really good for many reasons. First of all, from a VC perspective, you create proprietary deal flow, which is always a good thing. Secondly, you actually learn, you definitely learn what building a business is and isn't. And so I think your advice to founders is more credible and more insightful, hopefully. So I think the combination is pretty good. Now, that said, you have to hire people, recruit people that have the propensity, talent, skills to actually create a company, which is definitely not for everybody.
I mean, it's just hard to build a startup that is a public company one day. Like that in itself is less than 1%. Just doesn't happen. Very difficult.
We aspirationally will like to hire people who want to do it, would encourage our colleagues, to go through the exercise as well.
One thing I hear a lot I see it all the time with people incubating. There's a venture studio. You go out to raise a round and the studio owns way too much of the company. What do you think is the right way to think about how much ownership you take as that first fund?
I think it's critical to think about your cap table construction carefully. You do not want adverse selection in future investors, employees. One thing we definitely did correctly at OpenStore is we set up the company pretty well from a cap table perspective. Correctly. Lots of other parts of the business are hard and challenging, but we definitely were very thoughtful and intentional with the cap table. And so I think it's pretty important not to crowd out future success by being too short-term greedy. I did this before at OpenDoor was my first time doing this when I was at KD. And so I studied but back then I studied the entire world of, sort of every VC based, sort of company. How did it work? What were the economics? Truthfully, the answers were all over the map. There's a lot of different precedent, but came up with a theoretical approach that I kind of like, and I think works pretty well. But I think it is an important ingredient. It's not the most important ingredient, but it is an important one.
So what is the theoretical approach? How would you define that?
I like to basically say, hey, let's do the financing on standard financing terms. Then let's have the co-founder who is the VC negotiate with his or her co-founders for an appropriate equity stake based upon level of commitment, quality, insight, uniqueness, just as if I was going to be a full-time employee, and then divide by whatever fraction of time I'm allocating. So let's say in OpenDoor's case, what we did is for the role I was going to perform, let's say if I was doing it full-time, let's say I would have got caught 30%, just pick a number. And then let's say I was going to commit 1 day a week. So that's called 1/5 or 1/6. If you have to work 6 days, it's probably better, but divide by 5 or 6, and then that's my equity grant. Common.
And then the rest, all the, whatever it was, 4/5 of the 30%, does that go to the other co-founders then?
Yeah, or the overall cap table, which includes hiring, pools, and investors.
And you said you do the financing first, and then you figure out the split?
I mean, the financing terms are done kind of separately, meaning like, okay, we are going to invest in this company. Here are the terms we would provide. Then the common shares get reallocated back to the fund in my case.
So let's say if it was just make it simple. Founders Fund was leading this round. Founders Fund might buy 20% of the company, whatever's fair. Plus you got the bonus 5-6% based on your contributions as a co-founder.
And that's common. The 5 or 6 is common. And so I'm diluted just like anybody else, or we would get diluted on the common shares just like every other employee.
Your shares attributable to Keith, those are Founders Fund shares in the fund?
So at OpenDoor, I assigned them back to KV. The grant I have for being CEO, OpenDoor gets assigned back, OpenStore gets assigned back to Founders Fund.
Okay, so another question. You had a very controversial tweet that I thought was, I could see, rarely, you rarely have those.
No, I mean, I think I'm boring on Twitter now that, ever since Ryan Peterson started tweeting, I'm like, oh my God, like I need to upgrade.
You can't compete with that. This was a tweet. You said, exactly. Founders who chase trends and have FOMO will always fail. Not a single great San Francisco-based startup has been founded since March of 2020. There's a lot of people that disagreed. I could see the validity of that.
Still waiting for the, kind of counterexample. I'll give you the concrete phrasing that's probably easiest is there a company based in San Francisco that we wish at Founders Fund we were on the cap table? The answer is no.
And that's founded after COVID.
After March 2020. I think March 2020, because that's when COVID lockdown started. Technically, you could use March 14th if you really want.
Why do you think that is?
Well, I think there's several components. One is, first of all, the culture of San Francisco is completely misguided. And there's a couple of dimensions to that. Remote. We don't invest in companies that are remote at Founders Fund. So if you're going to have a remote company, we're not interested, and it's not going to succeed. That alone. As far as I can tell in the Bay Area, in SF specifically, I'm not aware of any scaled company, we could debate what that is, other than Rippling, that everybody is in the office every single day. And I don't think you can build a startup successfully without that. So that alone excludes all the San Francisco-based companies. Number two is the culture of entitlement. People in the Bay Area learned all the wrong lessons the last 5 years, which 5 to 7 years maybe, which is startup building is really, really difficult. And you don't get things, you have to earn them. And so that is more intuitive to other people in other parts of the country. And then there's a safety issue, which is at the end of the day, every time your car gets broken into in San Francisco, you're not going to get any work done that day. And guess what? You're going to have an employee have these kind of issues every single day. So someone's disrupting your company every single day because San Francisco is completely unsafe.
When was the last time you went back to San Francisco?
Well, I go back about every 3 months-ish. I still have some board meetings from like prior, investments. I do think there are companies that, were founded 5, 10, 15 years ago that are, will be successful. So I try not to go back too often, but I'm pretty committed to several of these companies are going to be really good companies. So I'll fly back in for a board meeting. I'll typically stay for 24 hours and try to get the hell out.
Yeah, we had a couple requests for that question to be answered. One other one that a lot of people have asked, why Miami? You could have gone anywhere.
I did both a personal and professional filter on this back in 2020 because diagnosis was like COVID. San Francisco is going to get worse before it got better. It may get better. Good luck to Gary Tan and his friends. Try to improve things. I think there's a fundamental blocker, which is voters get the politicians and policies they deserve. It's not like there's this class of politicians that invaded San Francisco and took over, and then you can take it back so easily. It's the voters in San Francisco have views that are just incorrect and wrong and have been proven for centuries to be like stupid. And the politicians are just reflecting the views of their constituents. So you have to fix the views, which is a more fundamental shift. It's a cultural shift. It's an education shift. So all politicians are they have good antenna for product market fit. And if people that live there have stupid views, the politicians are going to do stupid things. So you got to fix the people first. And I think that is a bigger challenge. I lived through this actually in New York City when I was growing up. Bankrupt, they had power outages, there was crime. My parents wouldn't let me take the subway past 5 p.m., like very serious issues. And even though 80% of the city is a registered Democrat, people just got so frustrated they voted for Rudy Giuliani and said, fix this. We don't care what you do, just fix this damn city. So you need to get that level of frustration before people are really going to change. And maybe San Francisco's there, but then it takes years, et cetera. And maybe they're not there yet. Maybe you need more frustration. And then there's another layer, which is the state policies are a complete mess too. So at least in New York City, the state policies weren't so bad. It was really a New York City issue. There's a little bit of the state that needed to be tuned and tweaked, but you have this weird interface now where it's not even clear if you fix San Francisco without fixing the state. I tweeted some stats yesterday about California. It's like last in everything, last in education, number one in poverty, number one in homelessness, number 1 or 2 in drug use. Like every bad thing is number 1 or number 2 in California. So you got to fix that too. Anyway, I wish Gary the best and people that are, helping him and working with him. But so we have this filter and diagnosis that things were going to get much worse in California generally and San Francisco specifically before they got better, which is almost surely going to be proven to be true. So we said, well, where would we go professionally and personally? And had a couple simple filters. International airport. I need to travel 2 founders. Founders need to come to me. It's pretty important. Number 2, I personally wanted warm weather. I don't like cold weather. I like warm weather. It's not like you couldn't survive in some cold environments, but I personally wouldn't be happy. I like vitamin D. Third is I wanted something moderately cosmopolitan to do in terms of cuisine or shopping actually was an intentional filter. Actually, ironically enough, it actually was very top of mind. And then we needed to have what I defined as a reasonable tax rate, which would be sub 5% or less. So it didn't have to be 0, but it had to be reasonable.
This is state level tax, right?
State income tax, yeah. And then with just those criteria and layer on, it has to have a Barry's boot camp, and you're stuck in Miami pretty quickly.
Yeah. But I mean, the interesting thing, when you look at some of the data on, what are the biggest tech venture markets, I mean, Miami has been pulling its weight.
Yeah, well, I felt like Noah's Ark. I felt like Noah and Noah's Ark in the beginning of I need 2 designers, I need 2 angel investors, I need 2 VCs, I need 2 engineers, 2 founders. We're going to put them on this boat and we're going to ship them all to Miami. That's what it was really like, actually. And so, like Noah's Ark, we got here and we're in the promised land and people are like happy and smile and safe. And they do tell their friends that it's like happy, smile. And people come visit and they're like, oh my God, everybody's like happy. And I have this other thesis that the entrepreneurs are humans, which sounds controversial, but entrepreneurs are people too. And people want to be happy. And at the end of the day, if you give them an environment where they can thrive professionally and ambitious people can succeed, and the culture encourages success, which is another dynamic with San Francisco. Here, people celebrate success. When you have kids in Miami, everybody teaches their kids that they should emulate successful people. There's none of this resentment of success in any field or money or anything like that. And so I think that's extremely healthy, especially if you're raising a family, is that aspirational success is something to be desired and emulated, not criticized. And so you get a suboptimal amount when people stigmatize success. Nobody in Miami would ever stigmatize a successful person. And so I think that's fundamentally also important. We have seen that the companies we fund in Miami are doing better by far than companies fund elsewhere on average. Yeah, so I'm very happy about that. We're very excited about the prospects of the companies we funded into Miami. We've also seen a new trend emerge, which isn't surprising, but it was necessarily not intuitive to me initially, is there's now a new New York, Miami hub where we see companies going back and forth and having offices in multiple cities. This has been true in finance, forever. So maybe it shouldn't have been surprising. But for example, Ramp, we do 3 of our 4 board meetings a year here in Miami because 3 of the 4 board members live in Miami, including 2 of the 3 co-founders effectively and 1 of the 2 operating founders. So for example, Ramp has an office literally a couple floors below where I'm sitting right now. We've seen other companies really kind of pioneer this hub. So I think you're going to see this corridor of New York, Miami, where companies go back and forth or colleagues go back and forth seasonally, which has always been true on the East Coast. And that's a very new dynamic. And it's kind of exciting, actually. I've been investing a lot in New York. So one of the stats I looked at recently, about a year ago when we were doing an LP presentation, was my number 1 geo for investing over the last 2 years has actually been New York. And it used to be less than 5% of my investments my first 8 years of my career. So a massive change. It's like roughly 15% now. Just because I'm on the same time zone, I can get to New York founders really quickly. They actually enjoy coming down here.
Yeah,
I'm often willing to jump on a plane and they're like, no, we'll meet you in Miami.
Yeah, we want to visit.
It's the same thing true of Latin American founders. I actually initially thought I'd be flying to Latin America a fair amount. Every single time I've been interested in a Latin American company, the founder says, no, don't worry, I'll come to Miami.
Yeah, I was going to say, I have 2 portfolio companies based in Miami. They love it. And both, I don't know, I guess I took my average Miami with the average rest of the portfolio. They're just doing so well. They're probably outperforming the portfolio, but they're great.
Where do I write a check? Send me some wire information.
Yeah. I'll shoot you the wire instructions right after this. You had another really interesting comment that I think it's worth digging into. This is a question from Rohit Krishnan on Twitter. He said, why are you bearish on AI companies?
Oh, yeah. So I had a long, elaborate discussion on CNBC a couple of weeks ago. I'll give you a short version is, there's disruptive technology innovation and there's sustaining innovation. Chris Dixon wrote a great blog post 5 or 10 years ago about it. Just read that. I think the incumbents will benefit almost all the time from disruption in AI. And so it can be incredibly impactful for society. So I wouldn't confuse value creation and value capture with whether something's a good VC investment. So we only win as VCs and entrepreneurs only succeed if incumbents really don't win that race. I think a lot of AI use cases are sustaining innovations, and that the incumbents are very fast to the switch right now, which is unusual for technology disruption. And then third, I think there are some vertical instantiations where AI can be very successful, but I think the companies themselves will not brand themselves as AI companies. They'll have a product or value proposition that is really compelling, and AI is the magic that is the why now kind of answer. And that I'm very excited about investing in. If you have one of those, we're totally interested. But AI qua AI is not exciting for us. We also think that, Peter Thiel has this old expression, which I believe by the time something becomes like a buzzword, it's too late. You don't really want to be investing in something that's already a buzzword.
And it's probably analogous to Uber is technically a cloud company. It's technically a mobile company, but no one calls it that. It's the problem that's being solved.
Really, what is the value proposition for who? And the more, succinct and powerful that is the important thing. The driver can be a technology. That's great. But you want to think customer first, and the use of various technologies is the ingredient that answers why now. Why is this possible? Why is this going to be better?
Last question. Do you have a favorite interview question when hiring?
Actually, I sort of do. I'll give you a few. One is actually when I'm hiring, I actually like to start with what are you trying to accomplish? Like, what are you trying to achieve? Not every company, not every role is appropriate for everybody. And some people would thrive in some roles in some companies, and they would be a disaster in others. So first is just like, what do you want? Because then it helps me matchmake you. Is this a good fit or not? Another one, I like to ask people if they were CEOs of a particular company they came from, what they would have done differently.
And what does that teach you?
Well, you can see how much they really understand the business. The more I know about the business that we're talking about, obviously, the more useful the dialogue in some ways. But generally speaking, I've been involved in, or, 1 or 2 degrees removed from a lot of technology businesses over the last 23 years. So I can usually frame a reasonable amount of follow-up questions. But it also allows you to see whether the person has an ownership mentality, what they pick up on of what worked, what were the ingredients that were very successful, and what could have been tweaked to lead to a more ambitious outcome. Those are probably my 2 favorite.
Yeah, I've never heard that second one before. That's a good one.
And then the last kind of classic question is sort of if like you were a product compared to other people with like kind of similar resume, LinkedIn profile, what's your value proposition? How are you most different than other people who have a similar LinkedIn profile?
Awesome. Well, this has been great. Thanks for coming on.
Thanks for having me.
And thank you for listening. If you want to support the show, send this episode to one friend who might like it. If you don't want to miss future episodes, subscribe to the newsletter in the show notes and get new ones in your inbox the moment they drop. Thanks again to Keith for coming on. Make sure to check out OpenStore if you want to sell your brand, OpenStore Drive if you want that sweet passive income, and Packsmith if you want to upgrade your 3PL. I hope you learned something new. We'll see you next time.